Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today we've got another listener question from Adam. Adam, thanks for your question.
Thanks, Dallas. So Adam writes in, "Hi guys, regular listener and love your show." Thanks, Adam. Very informative about superannuation and 10 years to retirement, as I am 54. I really liked your view on how much money to keep as cash and super, and I like the idea of keeping a lot in high growth, and for the last 2 years start to build up some cash so that when you retire you have about $70,000 to $100,000 in cash when you retire. My question is that where do you draw your pension from, and at what stage of a downturn do you start to use your cash reserve? Is it a 5% drop or a 10% drop? This might be a good topic for a podcast. Would love to hear back. Thanks, Adam.
Well, I think this is an interesting one because we have touched in a fair bit of detail about how it makes sense to have some money in cash when you get to retirement in the event of a drop, but we really haven't gone into the details of what that consists of. Now, my first thoughts on reading this are that a 5% drop or a 10% drop is there is no black and white right or wrong answer here. But I would suggest that a 5% or 10% drop is not enough of a drop. Now,
yeah, I would agree with that.
On average, every year you're going to have a 15% drop. If your money is invested in the biggest companies in Australia and around the world, the intra-year average decline is about 15%. So that's just sort of par for the course every single year. So if you're reacting to a 5% drop or a 10% drop or even a 15% drop, you're going to be turning the tap off and drawing out of cash every single year, which is not really the purpose or the intent of that cash reserve.
No, let's assume for a minute. Yeah, you obviously the question, you are retired here, so you're relying on your income that you draw from your retirement savings, basically. So I won't say, because I say it all the time, that your money has to get dressed and go to work for you. In retirement, but that's exactly what's happening in this example. So people generally draw a fortnightly income or a monthly income because that's when their expenses occur every fortnight or every month or every day. So the question is, so effectively, our preference is to draw down from someone's growth assets.
Yes.
While markets are stable.
Yeah. And
with the absence of significant downward volatility, our preference is to be drawing out from the growth proportion.
Yeah, predominantly.
So what that means is that if someone's drawing $8,000 a month, for example.
Yeah, well, let's use the example of someone who's got $2 million as a couple. They've got $2 million in account-based pension, and they've got $200,000 of that in cash. And they're spending $8,000 a month, which is effectively $100,000 a year. So
so we would have that $8,000 a month coming out of the $1.8 million of growth assets if they held. That's if they held their cash inside, but inside you're talking about inside the fund.
Well, I mean, basically the way that I would think of it is if you're holding that cash inside the pension account, you would probably be drawing out your $100,000 a year on a prorated basis, where you'd be drawing out some from the cash but the majority from your.
Well,
share.
yeah.
I guess this is one of those things where this is a bit of a finer detail that doesn't actually really matter which way you skin that cat.
Yeah. So while the markets are good. It's a difficult question to answer because what we're talking about So we're talking about market timing by another name, really. We're talking about market timing by another name.
Well, that's exactly what I was thinking.
The backup money that people have
Yep.
is essentially market timing by another name.
It is. It really is.
Because of the fact that if you look at the longer term averages,
Yes.
the
longer term averages, they should just have the whole lot in companies and have nothing in cash and just forget about it.
Yeah,
and do it that way.
so we have now. I know that we have said before, because we have done podcasts of this. We have said that any cash that's held
Yep.
is a luxury.
Yes.
Is a luxury,
Yep.
and not necessarily a necessity.
Yep.
I have some clients that don't have enough retirement savings to have the luxury of holding much cash at all.
Yep.
So we have more of a conversation around the acceptance of volatility and the need or the inability to hold significant amounts of cash, because there's that cash drag. And right now, when we're recording October 2021, the cash drag has never been as high.
Yeah.
We're looking at rates of return significantly less than 1% for cash and fixed interest. They've never been that low in modern history, certainly.
Yeah.
So there is what we call a cash drag in that for every 10% of your overall retirement savings pie that you're allocating to cash and fixed interest, you're giving up some longer term rate of return.
Yeah.
Back to the specifics of the question.
Yeah.
So, generally speaking, what we would do so you're going back to an example of someone with $2 million, a couple, they have $200,000 of cash and fixed interest, not earning them much of a rate of return. They have $1.8 million in growth assets. They would generally draw their $8,000 a month, typically from the growth assets. And what they would do is they would leave the $200,000 that they have in cash and fixed interest alone and not draw anything from that. At some point in time, there'll be a drop, and the question is,
at what
percentage, at what minus percentage do you change and stop selling down your growth assets, or stop drawing your income from your growth assets, the $8,000 per month, and swing that to drawing from the cash?
Now, so we could easily go down the rabbit hole here of saying, well, what you might actually do instead is draw it on a pro rata basis and then rebalance every year to bring you back in line. That's another whole podcast in itself. I think let's actually answer Adam's question rather than get into the weeds of that. But so the way that I think of this is the drop that you need before you start to draw from the cash is inversely proportional to the amount of cash that you hold. And what I mean by that is if you've got a huge amount of cash, you can afford to pull the trigger a bit earlier, because you go, okay, well, so I probably wouldn't, I'd never, it doesn't matter how much cash I have, I'd never go less than 20%, because otherwise you'd be just driving yourself mad every year filling out paperwork to go, oh, it's down by 15% as it is every year. We're drawing from cash. Okay, now we're going to stop drawing from cash and go back. So 20% would be, I'd say, the bare minimum. But that 20% would be if you had 5 years worth of cash, because what you've got to bear in mind here is that if you react to the 20% drop, you start to spend some of your cash. And so we don't know, just because you've hit 20%, things might go down much more, and they might stay down for quite a while. So if you've only got a year or two, say if you've got a year of your money in cash and you pull the trigger at 20% down, there's still a fairly high chance that a year on from that point, you will either, company prices will have continued to drop, or will have dropped further and stayed down, or will not have recovered by that time. So I'd really only be pulling the trigger on 20% down if you've got 4 or 5 years worth of cash, and you can afford to do that.
And our house policy, if you like, is to have the conversation with our clients at 20% down. So we actually have we have the discussion with each client on a case by case basis, but our house policy is to revisit that at 20% down. So at 15% down, we're not necessarily having that discussion. Because as you said, Dallas, that's the average intra-year decline, and recovery is 15%. So if you're drawing an income draw every month of $8,000 in this example, then at 20% down, we have the conversation. We're in communication with our clients before that. We have the conversation on a case-by-case basis.
That's a really good point, because
at 20% now before that is like you said, it's just noise. It's just noise.
The way you phrase it, have that conversation, is a good point, because we can tell you how we always have a plan, and like, for example, I might say to someone, you've got 2 years worth of, and again, this isn't personal advice, but for example, I might have someone who's got 2 years worth of cash, and so I might say, well, we're not going to change.
And when you say 2 years, what Dallas is referring to there is they've got 2 years of their income.
So in that case, they've got $2 million in retirement savings. They're spending $100,000 a year. Of their $2 million, $200,000 of that is allocated towards cash. We might have a rule of thumb where we say, at either 25% down or 30% down, but it's just a rule of thumb at this point. We go, we're not going to draw out of the cash until we've hit 30% down from previous highs. Now, the point you just made is a good one. So I guess that's an example of a plan that you might have, but practically what happens here, and you just touched on that, is that we start having a conversation, because the point of that cash is like a security blanket. The point of the cash is to allow you to feel okay with the volatility of your remaining assets, and to allow you to get that long-term growth. So what practically happens there sometimes is that if there's a 20% drop, and I've got a client who is just stressed out and can't sleep, and really stressing about the fact that their super balance has dropped, and they're really worried about the fact that they're going to run out of money, I might actually turn the tap on then and say, right, well, let's just start drawing into cash. And what that actually allows that person to do is pretty much just tune out the noise from then on of prices dropping or coming back up or what's happening, because it's almost a trick of the mind where they go, well, I'm not selling shares anyway, so it's fine. I'm just drawing out the cash. And so the point that you're almost setting it as like a thing where you want to start drawing out of your cash before you start to stress too much about it, and before you get in the position where you're going to make a really big mistake and do anything to the rest of your the $1.8 million that you've got in your pension account. So, as you say there, it's a plan that you have in place, but it's realistically more of a conversation where you might go, prices are down by 20%. How are you feeling about this? And some people will go, are they down? I haven't even noticed, hadn't even paid any attention. You go, okay, well, we don't need to worry about how you're feeling about this, because you just haven't even noticed it. Whereas you might have other people that are going, I'm turning on the TV in the middle of the night, checking how the Dow Jones is going, and I'm stressing out about this, and I can't sleep because I'm worried about what's going to go wrong. We might turn that over to cash earlier, because that's, I think, the big thing here is it's not necessarily that it's it's not a maths question in terms of going, this will get you the best result. It's this percentage drop, and we have to wait until that percentage because of this. It's really around, what do we do with this cash that helps you not have to sell down your biggest and best companies at a steep discount, but also what do we do with this cash that allows you to stay the course and not panic and not sell at those times when there's a drop?
Yeah, absolutely. Definitely case by case there, because it's a war chest. Yeah. It's a war chest, and people become panicked at different points in time. So if that certainly allows someone to sleep better at night, then that's a good thing. Yeah. There is no exact science around this.
No,
because when again, if you go back and I'll reference these figures so I don't have to fact check them, but the great, and I think we're being overly generous to cash and bonds here, but the great Nick Murray says the long-term averages of good quality companies is 10%, around the 10% mark. The long-term average of bonds and the bonds is 6%, which is cash by I guess a different name. Yep. And the long-term average of inflation is about 3%. So if you work with those figures, you would say, okay, well, 10% for, if I can assume historically looking, 10% for great quality companies, 6% for bonds, which is lending to governments and those good quality companies. I'll take more of the 10% any day over the 6%. Bonds are probably an unfair comparison as well because they fluctuate in price. So if we're coming back to cash and fixed interest, right now, we are looking at because that's really the only thing that won't fluctuate, cash and fixed interest. We're looking at under 1%. Now, historically speaking, of course, the good quality companies of Australia and the world have done many multiples of 1%. You know, they're more like an average of 8%, being conservative over longer term periods of time. Backwards looking, of course, but so how much more of the 8% do you want compared to the under 1%? I would suggest most people, it's not a case of wanting, it's a case of needing. Most people need much more of the 8% than they do of the 1%. So you come back to how much cash is right for someone to hold. It could be as little as a couple of $1,000. It could be as high as
5 years worth of income.
5 years worth of income. Their income needs depending on what they can afford. I mean, I have clients that hold 5 years worth of income, but they can afford to.
Yes, I was just
in cash and fixed interest. And so it's a very hard question to answer. I guess what we could definitively answer today, because I think Adam's probably looking for that. We feel that a 5% drop or a 10% drop is just too. It happens too frequently, and it doesn't make a large enough difference.
No.
Either way, and it's too early. Our thoughts are it's too early to deploy your cash. You're holding it for a significant drop. You're holding it for, let's say, another global financial crisis style drop. That took 18 months to get to the bottom, and then some length of time to recover. You're holding, the whole point of that cash is to hold that time. Throughout one of those significant drops. A 5 or 10% is just pulling the trigger too early, in our opinion, most of the time.
That's right. And I think that's, so I guess to make that point of, if I've got clients who've got 5 years worth of income in cash, they can probably afford to, they can start drawing their income from their cash at, say, a 20% drop, for example. Now, it answers itself, I guess, but if I've got clients who they just cannot afford to own pretty much anything in cash, well, the answer becomes there is no drop that makes them draw because they just don't have the cash. So it's that's, I guess, what I was saying. It's a function of the amount of cash that you can afford to hold is a function of how much have I got in terms of how many multiples of years worth of income do I have, and then the question of when do I start drawing from that cash is a function of how much cash do I hold. So if I've only got a year or two of cash, I probably wouldn't want to be pulling the trigger even at a 20% drop because I'd be going, that's too regular, and I'm going to burn that up too quickly. So I might want to wait for a 25 or a 30 or even more % drop. Whereas if I've got 5 years worth of income, I might say, yeah, sure, at 20% down, let's start to draw out of that because I got 5 years. So even if we get to 20% and then we keep going down like in the GFC and then take years to recover, I've got 5 years. I'm going to be fine in that. Yeah. So I guess like we've done here, it's like the SBS movie where poor old Adam's asked the question of when do you start doing this, and we've left with, well,
Well, I think we've definitely cleared up that 5 or 10 is not enough.
Yep.
And you'll drive yourself crazy.
Yes.
Looking at 5 or 10.
Even the concept of keeping a track of that will drive. Like a lot of these decisions around how much cash to hold and when to start drawing from it and when to top it back up. The answer around that is more around how it's like a sleep at night question where you go, how do we come up with a plan that is going to allow you to not pay any attention to this?
Yep.
It's a weird thing where we're thinking about money in a way to allow you to not think about money anymore.
Yeah.
So if we're going to react to a 5% drop, we're going to be drawing your attention back every couple of months.
Lying on the beach of Magnetic Island. it will just ruin you if you're looking at you got your phone out looking at the
4.8% down. I'm going to need to get in and change my
if it's a 5 or a 10% drop down, it's just going to ruin your holiday. And we want you to be traveling a lot in retirement if travel is your thing.
Yeah.
So I mean, you want to have rules of thumb set.
Yes.
But when you need to look at it, you look at it intently. Yep. But apart from that, you let your rules of thumb, you let the plan dictate.
Yes.
Your actions.
Yeah.
And most of the time, your actions are doing very little.
Yeah. Exactly. Very good. Well, thanks for the question, Adam. That's a good one, and thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. We look forward to catching up again soon.